The most important buyers in the gold market are not traders, and they are not retail. They are central banks, the institutions that print the world's currencies. And for 3 years running, they have been buying physical gold at the fastest pace recorded in modern history. These are the most informed financial actors on the planet. They are quietly trading their own paper money for metal. And almost nobody is asking the obvious question. I'm going to walk you through 3 publicly traded ways to position behind this move to own the same shift the central banks are making without trying to outguess them. Not a single mining stock that lives or dies on one mine in one country. Not a generic commodity fund that owns 40 things and a strong view on none of them. Real exposure, structured so that if this is what it looks like, a slow, deliberate vote of no confidence in the old monetary order, you are positioned ahead of the crowd that figures it out later. The people running the world's reserves are sending a signal with hundreds of billions of dollars. The trade I want to show you is simple. Do not argue with the most informed buyers in the market. Stand behind them and own the thing they are accumulating before the rest of the world understands why. Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is gold is up. The story underneath is a slow, deliberate change in how nations think about safety. To understand it, you have to understand what a central bank reserve actually is. When a country sells more to the world than it buys, it accumulates foreign assets, a national savings account. For decades, the default place to hold that savings account was United States government debt, treasuries. Treasuries were considered the safest asset on earth, deep, liquid, and backed by the world's dominant economy. But here is what changed the calculation. In recent years, the world watched financial sanctions used as a frontline weapon. When a major economy was sanctioned, a large pool of its central bank reserves, held in Western government debt and currencies, was effectively frozen, locked, made unusable. Every other central bank on earth watched that happen and drew the same lesson at the same time. A reserve asset that another government can switch off is not, in a crisis, a reserve asset at all. It is a hostage. Here is the part that should be tattooed on every trader's monitor. Gold is the one major reserve asset that is nobody else's liability. A treasury is a promise. The United States government promises to pay. A foreign currency deposit is a promise. Some bank in some jurisdiction promises to honor it. A bar of gold sitting in your own national vault is not a promise from anyone. It cannot be frozen by a foreign capital. It cannot be sanctioned. It does not depend on another government's goodwill. In a world where the safest paper asset turned out to have a political off switch, gold's oldest and most boring property, that it is no one else's IOU, suddenly became its most valuable one. And the numbers show central banks acting on exactly that logic. For 3 consecutive years, central banks as a group have bought more than 1,000 tons of gold annually, roughly double the average pace of the prior decade. That buying has been led by emerging market central banks, the ones most exposed to the risk of a Western freeze. This is not a trade. A central bank does not flip gold for a quick profit. This is a structural, multi-year reallocation of how nations store their wealth, and it is still in progress. So you have the most informed financial institutions on earth steadily moving out of paper and into metal. When that happens, 3 things get extremely valuable extremely fast. First, the most direct, lowest friction ownership of the metal itself. Second, the companies that dig the metal out of the ground, the ones whose profits rise faster than the gold price itself. Third, a specific kind of financing company that earns a perpetual cut of mining output without taking the operational risk. So I am going to give you one vehicle per layer. 3 names, 3 different ways to express the same macro bet. Name 1, the Spider Gold Shares Fund, ticker GLD. You might think it is too obvious to name a gold fund as the first idea. It is not, and the reason is the whole point. This is the largest and most heavily traded gold exchange-traded fund in the world. Its structure is simple. The fund holds physical gold bars in a vault, and each share represents a fractional claim on that metal. When you buy a share, you are, in effect, buying a small, stored, audited piece of the same asset the central banks are accumulating. And here is why I lead with it rather than something more exotic. The central bank thesis is, at its core, a thesis about the metal itself, about gold's monetary role rising as confidence in paper reserves erodes. The cleanest way to own a thesis about the metal is to own the metal. A mining company adds operational risk. A mine can flood, a government can change the tax rules, costs can blow out. A financing company adds its own structure and complexity. This fund strips all of that away. It is the closest a public market investor can get to simply doing what the central banks are doing, holding gold, without renting a vault and buying bars personally. Here's what changed in how to think about this. For a long stretch, gold was treated by Western investors as a relic, an unproductive lump of metal that paid no interest, generated no earnings, and just sat there. In a world of low inflation and trusted paper money, that critique had real force. Why hold a barren asset when a government bond pays you to wait? But the central bank buying has quietly exposed the flaw in that thinking. The criticism that gold pays no yield assumes the alternative, the paper asset, is genuinely safe. It assumes the bond will be honored and the deposit will be accessible. The whole lesson of the reserve freezes is that, for some holders, that assumption broke. And once you can no longer fully trust that your paper savings will be there when you need them, the fact that gold pays no yield stops being the point. Gold's job is not to pay you. Its job is to be there, unencumbered, unfreezable, final, when other things fail. The central banks have re-rated that property with real money at record scale. This fund is the simplest instrument that lets an ordinary investor hold the same property. So what is the actual case for owning the metal here? It rests on a simple structural argument. The supply of gold grows slowly and predictably. Total above-ground gold increases only a small percentage each year, limited by what mines can physically produce. It cannot be created by decision. The supply of paper money, by contrast, can be expanded by a central bank's choice, and over the long run, it generally is. Now layer the reserve shift on top of that. You have a slow-growing asset suddenly facing a new, large, price-insensitive class of buyers, central banks, who are not buying for profit and will not sell on a dip. When persistent new demand meets a supply that physically cannot surge to meet it, the long-run pressure on price runs one direction. And gold has historically also done something useful in a portfolio. It has tended to hold or gain value in exactly the environments that hurt stocks and bonds, like a serious inflation scare or a geopolitical shock. So you are not only positioning behind the central banks, you are adding an asset that has historically zigged when the rest of a portfolio zagged. That combination, structural demand plus genuine diversification, is the case. Now the bear case. 3 things to watch. 1. Gold genuinely does pay no income. If you are in a long stretch of high real interest rates, holding gold has a real opportunity cost versus a bond that pays you well. 2. The central bank buying could slow. If it does, a large and steady source of demand thins out and the price loses a key support. 3. Gold has already run a long way, so a lot of the reserve shift story is arguably reflected in the price already, and crowded trades can unwind sharply. So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. This fund is the core holding of the trade, the simplest, most liquid way to own the metal at the center of the thesis and the position everything else is built around. Watch two things. First, the central bank buying data, the quarterly figures on official sector gold purchases. As long as central banks are net buyers at an elevated pace, the structural demand pillar is intact. Second, real interest rates, the interest rate after inflation. Falling real rates lower the opportunity cost of holding gold and tend to support it. As long as central banks keep buying and real rates are not screaming higher, the core position is doing its job. If central bank buying clearly reverses, if the official sector turns into a net seller, that is the signal that the central pillar of the thesis is cracking, and that is your cue to reassess. Name 2, Agnico Eagle Mines, ticker AEM. This is, in my view, one of the highest quality ways to add leverage to the central bank gold thesis. And to see why, you have to understand a concept that trips up a lot of investors, the operating leverage of a gold miner. A mining company has two big numbers, the price it sells gold for and the cost it takes to produce that gold. The gap between them is its profit per ounce. Here is the key. The cost of mining an ounce is relatively fixed in the short run. It is the diesel, the labor, the equipment, the power, set largely by the mine plan. So when the gold price rises, the cost does not rise with it one for one. The cost stays roughly put while the selling price climbs. That means the profit margin, the gap, widens faster in percentage terms than the gold price itself. A modest move up in gold can translate into an outsized move up in a miner's earnings. That is operating leverage. It is why a well-run miner can act like a turbocharged version of the metal. And the central bank thesis is, fundamentally, a thesis for a structurally higher gold price, which is exactly the environment in which that leverage works in your favor. So why this particular miner? Because operating leverage cuts both ways. It amplifies a miner's earnings, but if the company is badly run, it also amplifies every problem. The gold mining industry has a long, painful history of destroying shareholder capital, chasing production growth at any cost, overpaying for acquisitions at the top of the cycle, and digging mines in places where a government could seize them. So leverage is only worth owning if it sits on top of quality. This company is widely regarded as one of the best-run senior gold producers in the world, and the reason centers on one deliberate choice: geography. It concentrates its mines in stable, predictable jurisdictions, regions with established mining law, reliable courts, and a low risk that a government suddenly rewrites the rules or seizes the asset. A gold mine, by its nature, cannot be moved. It is a fixed bet on the ground it sits in and on the government that controls that ground. A great ore body in a politically dangerous country can be worth far less than a merely good ore body in a safe one, because the safe one is far less likely to be taken from you. This company built its reputation on choosing the boring, safe ground, and that is exactly the foundation you want under a leveraged bet. The numbers that matter for a miner are different from the numbers for the metal fund. The first is a cost measure, the all-in cost to produce an ounce of gold, including not just the mining, but the sustaining capital. You want this number low and stable. A low, controlled cost base is what gives the operating leverage room to work when the gold price rises. The second is the reserve life, how many years of gold the company has identified and can economically mine. A gold mine is a depleting asset. Every ounce sold is an ounce gone. A miner that does not keep finding or acquiring new ounces is slowly liquidating itself. A long reserve life means the company can keep producing for years without scrambling, without overpaying for a panic acquisition at the top of the cycle. When you have a low cost base and a long reserve life and stable jurisdictions, you have a miner that can let the central bank thesis play out in its favor for years, capturing a rising gold price with widening margins without blowing itself up in the process. That combination of leverage and durability is rare, and it is the case for this name. And here is the kicker. A high-quality miner does not just give you leverage to the gold price. It can also pay you to wait. When the gold price is strong and the cost base is controlled, a well-run producer generates substantial free cash flow. Real cash left over after it has funded its mines and its exploration. The best operators return a meaningful share of that cash to shareholders through dividends and buybacks. So unlike a bar of gold, which simply sits there, a quality miner in a strong gold environment can hand you an income stream while you hold it. Now, the honest catch. Mining is operationally hard. A mill breakdown, a labor dispute, a permitting delay, a cost overrun, any of these can dent a quarter. And the leverage that amplifies good news amplifies these too. But read that correctly. The operational risk is the price of admission for the leverage. You accept that a miner is bumpier than the metal in exchange for the chance that its earnings rise faster than the metal when the thesis is working, and for the income it can pay you along the way. The bear case. 1. Mining costs across the industry have been rising with inflation. If costs climb fast enough, they can eat into the very margin expansion the leverage is supposed to deliver. 2. This is a single company, and a serious operational failure at one large mine can hurt the stock even when the gold price is strong. 3. Gold equities as a group can lag the metal for long, frustrating stretches when investors are simply not interested in the mining sector. How I think about the trade. This is the leverage sleeve of the gold thesis, a way to turn a structurally higher gold price into potentially faster earnings growth on top of a high-quality, safe jurisdiction base. If you believe the central bank reallocation supports gold for years, and the data says it is still underway, a best-in-class miner is the way to express that with torque. Watch two numbers on every earnings call: the all-in cost per ounce and whether it is being held in check, and the reserve life and whether the company is replacing the ounces it mines. As long as costs stay controlled and reserves stay replenished, the leverage is healthy. If costs run away while the gold price stalls, the margin squeeze is the signal that the trade is breaking. Name 3. Wheaton Precious Metals, ticker WPM. We have covered the metal itself and a company that digs it out of the ground. But now step back, because there is a third kind of business in this sector, and it is the one most investors have never heard of. It is called a streaming and royalty company. And it is, in many ways, the most elegant way to own gold exposure that exists. Here's how it works. A mining company building a new mine needs a large amount of money up front. Building a mine costs a fortune before it produces a single ounce. A streaming company provides that money. In exchange, it does not take a loan to be repaid. It signs a contract giving it the right to buy a fixed percentage of that mine's metal output for the entire life of the mine, at a steeply discounted, pre-agreed price. Read that carefully. The streaming company pays once up front and then receives a slice of that mine's production, bought cheap, sold at the market price for decades. It owns a perpetual cut of the mine's output without ever operating the mine. This is the layer the market consistently underthinks. This company is one of the largest precious metal streaming companies in the world, holding streaming agreements across a diversified portfolio of mines operated by other companies. It does not run a single one of those mines. It collects a contracted share of their output. Here is why this structure is so powerful in the central bank gold environment. Think back to the miner and its biggest vulnerability: costs. When the price of diesel, labor, and equipment rises, a miner's costs rise, and that eats into its margin. The miner carries all of that operational and inflationary risk. The streaming company is structurally insulated from it. Its cost to acquire metal is fixed in the original contract, a low, pre-agreed price that does not move when the world gets more expensive. So when mining industry costs surge, the operating miner absorbs the pain. The streaming company's acquisition cost does not budge. That means a streaming company captures the full upside of a rising gold price while being largely shielded from the cost inflation that squeezes the miners. It gets the leverage to the metal without the operational risk of digging it. And there is a second advantage: diversification. A single miner is exposed to its own handful of mines. A streaming company holds claims across many mines run by many operators in many countries. If one mine underperforms, it is one stream among many. The portfolio absorbs the blow. So you get leverage to gold, insulation from cost inflation, and built-in diversification, all in one structure. And here is the kicker, the part that makes the streaming model genuinely special: free optionality. When a streaming company signs a deal, it gets a cut of everything that mine produces over its entire life, including ounces that have not even been discovered yet. Mines are routinely expanded. Operators drill, find more ore body, and extend the mine's life or raise its output. When that happens, the streaming company's slice of the larger production grows too, and it did not pay an extra dollar for that growth. It was already written into the original contract. So a streaming company gets to benefit for free from every exploration success and every expansion across its entire portfolio of mines. That is how a streaming company compounds. Not by digging harder, but by holding a diversified book of perpetual claims on mining output, capturing a rising gold price without the cost risk, and absorbing decades of free production growth as its operators expand. It is unglamorous, it is incremental, and it compounds, often with the highest profit margins in the entire gold sector. The bear case. 1. A streaming company depends on its operating partners. If a mine it has a stream on is run badly or shut down, its share of that output falls, and it has no control over the operation. 2. The best streaming deals are signed when miners are desperate for capital. In a long gold bull market, miners have plenty of money, and good new streams get harder and more expensive to source. 3. These stocks often trade at premium valuations precisely because the model is so good, so disappointment is punished. How to trade it. This is the highest quality, lowest operational risk way to express the central bank gold thesis. Leverage to the metal without the cost inflation and mine risk that weigh on a producer. You watch two things: the volume of metal actually delivered under the company's streams each quarter, and the pace of new streaming deals signed, the pipeline of future claims. As long as deliveries hold and the company keeps signing well-priced new streams, the compounding engine is running. If deliveries fall because partner mines are struggling or the company cannot source new deals, the growth part of the story is what fades. Now, and this is important, I would not bet the whole thesis on any single one of these names. I would think of them as a basket. Why a basket? Because the three give you the same underlying bet at three different levels of risk and reward. The metal fund is the pure, low volatility core. It tracks the gold price, no operational risk, no leverage, no income. The miner is the leveraged sleeve. Its earnings can rise faster than gold, it can pay a dividend, but it carries real operational and cost risk. The streaming company sits cleverly in between, leveraged to the metal, but insulated from cost inflation and diversified across many mines. Notice that those are three different risk profiles, not three different bets. If the miner stumbles on a mine-level operational problem, that does not touch the metal held in the fund's vault. If gold equities fall out of favor as a sector, the metal fund still simply tracks the price. When you blend the pure metal, the leveraged producer, and the insulated financier, you get the central bank thesis expressed across a smooth spectrum of risk, instead of betting everything on one structure. When you hold all three, the exposures roughly diversify each other while keeping the central macro bet intact. The institutions that issue the world's currencies are voting against their own paper and accumulating gold at a record pace, and owning the metal, the best miners of it, and the financiers of those mines is how you position behind that vote. One caveat. If you are going to trade the central bank gold theme, you have to respect what could end it. The whole thesis rests on eroding trust in paper reserves and a steady stream of official sector buying. If global tensions genuinely cool, if confidence in the dominant reserve currency is somehow restored, and if central banks slow or reverse their buying, then the central pillar of this trade weakens and these names can derate together. I do not think that reversal is near. The reserve freezes cannot be unremembered, and the buying has run for years. But the political risk premium in gold will swing on every shift in the global trust picture. Position size accordingly. Do not max out on any single name. And keep dry powder for when gold gets a sharp pullback on a risk-on headline and the whole complex sells off together, because that is when you accumulate. A few catalysts I am watching going forward. 1. The quarterly central bank gold demand data. Is the official sector still buying at an elevated pace? 2. The path of real interest rates, which sets the opportunity cost of holding the metal. 3. Mining cost trends across the industry, which determine whether miner margins expand or get squeezed. 4. The pace of new streaming deals being signed. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. 2 more names to keep on a watch list, but I am not buying today. Barrick Gold, one of the largest gold producers in the world. Bigger scale, but with more exposure to challenging jurisdictions. And Franco-Nevada, another major royalty and streaming company, a close cousin of the streaming idea, with its own diversified book. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For 80 years, the world ran on a simple, unspoken trust that the dominant reserve currency was safe, that the bonds of the dominant economy were as good as cash, and that a nation's savings parked in that paper would always be there and always be usable. That trust was the quiet foundation of the entire global financial system. And in the last few years, for a meaningful set of countries, that trust took a visible, permanent crack. The moment they watched reserves get frozen and understood that paper safety had a political off switch. The central banks did not hold a press conference about it. They responded the way central banks always respond. Quietly, slowly, and with enormous amounts of money. They began trading paper for metal at the fastest pace in modern history, and they have not stopped. That shift, the most informed financial institutions on Earth steadily rebuilding their reserves around an asset that no one else can freeze, that shift is the trade. The metal, the miners, and the streamers are not a bet on the end of the dollar. They are a way to position behind the people who manage the world's money while they quietly hedge against the system they themselves built. And when the most informed buyers move, you do not argue, you follow. 3 vehicles, 3 layers of exposure, 1 macro bet, the fund holds the metal, the miner digs it with leverage, Wheaton finances it and collects a perpetual cut. If the thesis is right, all 3 compound. If the thesis cracks, you will see it in a handful of specific metrics, and I will tell you here. That is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it, hit subscribe. I will see you on the next one.